If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Hey, looking good, Billy Ray. We are going to be talking about the Treasury bond market, boys and girls. Now, this is the long-term weekly. You'll remember the 135 pattern that we had way back when here last year in March. And you'll be able to see that we had the 0.3 was right there. This is a 135 pattern because it has 3 lower tops. If you're interested in these types of patterns that we see, you got to pay attention to what Mr. Basil Chapman will be showing you on December the 15th. Great information, folks. And he certainly knows the business as well as anybody on the street and on the sidewalks, too. Anyway, now you see we had the big ABCD pattern to the downside. Now, what we did was we said at that point, being where we were at point D down here, we said we were going to see a rally in the Treasury bond market that should be equal to the last one that was right here. And that amount equal to about $14,000. Well, guess what today, folks? The slot machine rang today on the Treasury bond market as we hit 131.31. That was the 50% retracement of the high that we made way back here, as you can see, back here in August. And we came down and we hit it today, 8 weeks up. And if you want to get into really high mathematics, get out your calculus book and remember that you must be able to count from 1 through 8 to see that it was 8 weeks up here. And you look at it here, how many weeks is it up? Whoops, here we are 8 weeks up. And what is today? Today's the day that Norm Winsky talked about yesterday. Remember the 14-day lunar cycle plus the lunar, I think he called it an occultation or something like that, which meant that Mercury was just basically like on the other side of it, almost like an opposition, so making extremely volatile times. And we're seeing that already in the stock market. Now, we did make the price objective that we were looking for. Well, that's not quite true because we were looking for the ABCD pattern in the E-mini S&P to finish up at 39.13, and we only got to 39.14. So it missed it by 1 point. And so far, we've had a pretty good rally, that's been going on for quite some time. So I think that's an important thing to remember, that we had a major bottom here, folks. We have to hold these levels. And from that level, the S&P rallied from 39.14. We rallied all the way up to 39.62 and then back down to 39.26. And the last I saw, we were trading about 39.42. So it's holding those bottoms, but just barely. But if you wanted to see a really bearish chart, is go look at the NASDAQ, folks. I mean, this chart is just absolutely bearish. So whatever this rally is and how long it's going to last, maybe a day, maybe an hour, maybe by the time we're done here, it could be over. But we're going to be going lower. There's no question about that. Now, the reason why, going back to the bonds for just a moment, the reason why I talked about the bonds here is because I was watching the bonds in the Treasury bonds, not the Treasury notes, because the Treasury notes look totally different. Bonds rallied 3 handles today, folks. They were up almost $3,000 at one time. They're still up a lot. I mean, how much are, last time I saw, well, they're up almost 2 full points right now. And so that tells, well, 1.5. So we were up really big time at one time, well over 2 points, not 3 points, but 2 points up, which is a huge amount. So this is an important day for Treasury bonds. If we close above 132, this is telling us that this bond market could make a much even larger correction to the upside in a bear market. And remember, that's what we're looking at here, because we've had lower tops and lower bottoms for 2.5 years. You don't have to realize that that's a bear market. Someone might have to tell you, but that's what it is. And so let's pay close attention as we're watching these things sort of unfolding. Now let's had lots of questions, folks, about crude oil and heating oil and gasoline that we've been talking about here for, this is the Wednesday of the week. Every single day I've brought that up to you. But you remember we kept mentioning to you about let's get this chart up because I want you to see it. By the way, our guest here at the break will be Jeff Hughes of Alpha Insights. And of course, Jeff is still quite bearish in the market. So I wanted to let him cover the market stuff because he's got some great charts. But I wanted to get to heating oil because this is the one that should be screaming to the upside. And the only way you can see it to the upside is if you're standing on your head looking upside down, because this puppy is breaking like a scalded duck to the downside. Let me get this longer term chart up here so you can be able to see it. We kept saying look for lower prices now because in the newsletter, we said watch for prices to get to around $64 a barrel in the crude oil. And this is in front of good news that we got from the Saudis saying, yes, we're going to keep prices steady. Well, the market said, well, your price is steady and my price is steady are two different things. So you got to listen to what the market is telling you and what someone from Riyadh is trying to tell you, because there's a big difference. As you can see here in the heating oil market, we have been coming down for several weeks now, well, months actually, but for the past month, look how far we've dropped, folks, from this level right up here all the way down, and this makes for a huge A, B, C, D to the downside, and that's down here below where the chart prices come in. So we are going lower. Crude oil is breaking badly again. We tried to rally $2 a barrel today, could not even make any type of retracement. And now we're breaking down, making new lows. I just saw about an hour ago, we're breaking into new low grounds. With the price objective on that ABCD in crude oil, it comes in at around it comes in at $64 a barrel as you're looking at that level right here. Gold is holding up relatively well. We had a pretty good break in gold down to that 1755 level. We rallied up. And we got up to as high as, I think, 1796. And now we're backing off a little bit, or roughly that same price right now. Silver's came back pretty good. It's rallied 50 cents today. So silver and gold are still in play. Looks like we could be looking at potentially higher markets, but they've got to get above those levels of 1805 in the gold and above $24 in the silver. Folks, I check the silver market here in Tucson at least once or twice a week because I have people asking me how to buy it. And by golly, they just don't have any inventory in it at all. I've never seen it this way in all the years that I've been trading. We've always had silver dollars and half dollars and stuff, and there's just nothing out there. I mean, it's just the premiums that they're paying for these things. If you bought a 1 ounce silver round, which is, made by the U.S. Mint, they're pure silver, and it says United States of America, but by golly, guess what? That thing has 1 ounce of silver in it, and they're asking, actually, believe it or not, you're talking about a coin that's got, it's a $1 gold piece, silver, all right, $1 silver piece, just like a silver dollar, only it's not a silver dollar. It's called a silver round. It's 1 ounce. Okay, now that's selling for roughly, on the market, if you were just pure silver, it's selling for $23.50. Okay, you're going to have to pay around $32 to $35 an ounce to own that here in Tucson. That's how rare it is.
Currencies, commodities, and bond markets are as important as ever right now with how they're driving the volatility in equity markets across the globe, which is why it's a great time to try out Teddy Kegstat's Tiger Forex Report. Teddy Kegstat breaks down the Forex markets every Monday using his 30-plus years of experience as a trading veteran of futures, Forex, stocks, and options. Teddy releases his weekly Tiger Forex Report every Monday morning with coverage of all the major currency pairs, including the dollar index, the euro dollar, pound dollar, dollar Swiss, dollar yen, as well as many more, and he also has weekly coverage of the crude oil market and the 30-year T-bonds, as they both influence Forex markets tremendously. When you sign up for the Tiger Forex Report, you also gain instant access to Teddy's 60-minute webinar archive he just hosted, Forex Strategies and Fundamentals, What is Behind the Tiger Forex Report. For all the details and start your 30-day Tiger Forex Report subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
Are you looking for a way to consistently add winning trades to your portfolio? Tom O'Brien is here to help. Tom O'Brien has been successfully trading markets for over 30 years. A frequent contributor to TD Ameritrade Network and CNBC, Tom O'Brien founded TFNN over 20 years ago to help educate investors just like you. Tom's daily market newsletter, Market Insights, is published every morning when the markets open to give you the competitive informational edge you need to succeed. These newsletters are packed full of Tom's advanced technical analysis and are geared to deliver comprehensive strategies for a successful portfolio. Get Tom O'Brien's newsletter, Market Insights, today and try all of our products and newsletters 30 days risk-free with our money-back guarantee at TFNN.com. TFNN, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, we're back, folks. I posted the chart of the E-mini S&P because people like to look at it, of course, but it's an hourly chart going back to the highs that we made last week. And of course, you realize now that we're below the lows before the Fed came out. We're back in here. Folks, the next chart I'm going to show you after this is the NASDAQ, just to show you how weak it actually is. But look at this, folks. All this market has been doing is making 382 retracements down here over the last several days. The high today, now we've made a lower low. We completed the ABCD pattern within 1 point right there. And then we have the little bounce coming in. I don't know if this is going to be a higher or lower. We did go a little above the 382 retracement. We're trading pretty much at that level right now. But what I'd like to do, and I think it'll take me just a second to get this up and running, is to show the NASDAQ, just to give you a really clear idea of how weak the tech sector actually is. Now, today's a big day because we have the President of the United States, I believe, is in Phoenix and Tempe, Arizona today, because what we're doing is we're looking at a site for what do they call these things? Doggone it, what is it? It's called a chip site, chips, not buffalo chips, computer chips. Buffalo chips are friendly here. But here is, I want to show you what the price level looks like here in the, let me get these lines out of the way so you'll be able to see it really clearly. This is where we are here in the, get this 382. There's what I want to see. Just take me 1 second, folks. I want to show you just how weak the NASDAQ is. Now, here's what I'm going to be showing you. This is the daily. I believe I went to an hourly to get the data in. I believe so. Let me double check. Yes, that's what I did. This is an hourly. The same thing. As you can see here, all we've been able to do today is to make a 382 retracement so far. Now, the answer for what I'm trying to get to is, why is this important? Because if we go back to the S&P, okay, and we go back to a daily chart, you're going to see just as clear as a bell. It's called a 4-hour chart, Larry, not a daily chart. And this is it right here. That's a scam call. Well, look at all those zeros. I've never seen that before. Wow, they're over. They're history now. Wow. That's a phone call that said 00000. I've never seen that before. And it's never seen me before, and it never will again. Okay, here is the 4-hour chart of the E-mini S&P, and as you can see, just as clear as a bell, it looks like we've got a really strong pattern coming in here at 38.75. Now, that'll be negated if we can take out these highs up in here. But what we're expecting now is nothing more than a 382 retracement over the next couple days. Now, if you remember, we had Norm Winsky on yesterday, and he was saying to us that this was a very key cycle date, December 7th and December the 8th. So the market should be bottoming in this area and then having a rally. And if it doesn't, that means we're going to go down lower and we're going to break below that 38.75. Personally, just looking at charts, I believe we're going to take that 38.75 out without too much trouble within the next few days. Now, you'll notice that the low we made back here on the 13th, okay? From that level, you can see how far we rallied. We rallied 6.5 weeks, folks, up to this level right here. And you can see how quickly we've come down, taking out all the lows, that were here, that were really important. The most important one, the fact is that we took out the lows that the Fed was talking about how wonderful it was. All right, well, it don't look so wonderful now. Now the Treasury bonds are still rallying and notes are still rallying, okay? And all that is just a small short covering rally. That's all it is. Interest rates are going to be going higher, not lower. And that's going to affect the U.S. dollar. And we've been talking about that for quite some time. And we've been short the euro and short the pound here. They've had really good breaks this week. But we're in an area now where we should back off a little bit and wait to see. Now, whether this date that Norm is talking about, it's related to the full moon and also related to the planet Mercury, where it lines up to that. And I think it's called an occultation or something like that. And to see that. By the way, I got a little heads up today, this morning, from Tim Boss's wife, and he was doing better. So thank you for all the white light and prayers coming through. And really, and the donations you're sending to me, please send them to Larry at Trading Tutor, and put a little asterisk there, 5th race at Aqueduct, because I'm going to bet it all on the number 3. Looks really good today, folks. Don't see how he can possibly lose. Now, those of you that don't know me realize that I am just joking about that, folks. It's my last of my Christmas jokes. So that's pretty much it. So let's remind ourselves of that. Okay, let's get back to this S&P, because really important where we are here, folks. We have made a bottom here at 39.14. Okay, since that time, we rallied up to 39.60. Okay, that's 45 points. That's quite a bit, but we're only setting at 39.46 right now, still 20 points below that. You would think that the market would go up, and it still might. But it's not going up. And if we go below 39.14, you're going to go to 38. There it is again. What is that? I've never seen this before, folks. Scam likely 0.0000000. Wow. I guess I have to turn off the phone. Holy cow, I've never seen that before. Well, a lot of things I've never seen before. Anyway, let's keep our eyes on the ball on this one. Very, very important. But also the Treasury bonds. I would highly recommend being short Treasury bonds today, folks, just because of the cycle. Anything above 133, you'd have to put the tapioca on the top of your head or on your face and say, this is not working. But that's about as, I don't think we're going to get above 132 based on this. The Treasury notes are lagging badly. I mean, they could barely make a new high above that level and then had a little bit of a rally. But the bonds are leading the way up. 6 weeks ago, you couldn't get anybody. 8 weeks ago, you couldn't get anybody to buy them. And today, you can't get anybody that wants to sell them. So that's some of the stuff that you're looking at here today as we look at some of these things unfolding. Remember, folks, tomorrow, our guest was supposed to be Tim Boss, but he's going to be replaced by my good friend John Person, former floor trader at Chicago Merc, and also the Board of Trade. Does some really great technical work, especially with the Dow Jones, and he's a master of channel lines. He will be our guest, and we will have a new guest right after the first of the year. His name is Mike Moore, M-O-O-R, from down in Tennessee, good old country boy, and his specialty is something that we all love, which is the black gold, Texas tea, crude oil, heating oil, and gasoline. Mike Moore, he's really got some great stuff, very experienced. He's been in business 30 years. And he will be really an added addition to our guest list here. But again, one more thing, give yourself a Christmas present. try to attend Basil Chapman's show on the 15th of December. That's a no-brainer, folks. It really is. You'll get your money's worth. You get a subscription to his service and everything, and you're going to need it with this coming volatility that we're going to be seeing here on all of these markets. As you can see, $10,000 swing in crude oil this week. Are you kidding me, Myrtle? Holy cow, that's a lot of money. And look at gold. It goes $110 an ounce before it corrects. These are monster moves, folks. And hopefully we'll catch some of them. We've been catching some of them, so that's what our game plan is, to stay on board. We'll be right back. 877-927-6648. Stay tuned for Jeff Hughes, Alpha Insights.
If you want to take advantage of this sector, now is the time to subscribe to my Gold Report. The Gold Report is a comprehensive look at the metal sector as well as the markets that move gold, which is the currency and bond markets. New subscribers get a 30-day money-back guarantee, so you have nothing to lose. Every Monday morning, I publish the Gold Report with coverage of gold, silver, bonds, the XAU, HUI, GDX, as well as more than 30 different mining equities. To see for yourself the types of profitable trades that are recommended within the Gold Report, sign up now by visiting TFNN.com. Don't miss out on the next great gold trade. Sign up today.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern. For free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Okay, folks, I'm back and we're speaking with Jeff Hughes of Alpha Insights right out of Minnesota. Jeff, are you there?
I am here, Larry. How are you?
Oh, just staying above ground, living my dream, my friend. Boy, I love this volatility. Shut the front door and raise the rent. Boy, we're getting a bunch of it, aren't we?
No doubt.
Hey, listen, why don't you start out? Holy moly guacamole, I hit the wrong button. Stay with me, Jeff. It'll get this chart up so that everybody can see it, and I'll be ready to go. But, boy, the market sure came down hard from that last Thursday when everybody wanted stocks. It's really quite amazing. Now, you got a chart here about the most severe rate changes. You want to tell the folks what you're looking at here?
Yeah, we pulled this from Statista, and they are a service that really focuses on looking at historical, economic statistics. And the rate cycle that we're currently involved in right now, which is highlighted in red as 2022, is actually the steepest and most severe cycle that we've seen in over 40 years, going back to at least 1983. And, the point of this is that this cycle does not even include the rate hike that's expected next week. So once we add another 50 basis points to that, it's really going to eclipse anything that we've seen in the last 4 decades. And in fact, there's at least 2 more small rate hikes expected next year. And, we don't know. That could change. They're already, inferring that there's possibilities that the terminal rate could, exceed 5% and be as high as 7%. I don't expect that, but, it's within the realm of possibilities. And so, we have to really try and think about the implications for, the economy and earnings with rates as tight as they are right now.
Now, your next chart is about this. I think it's the same thing, extreme yield curve inversions. Is that pretty much related to what you were just looking at?
It is, because, what we've seen in addition to these short-term rate hikes that we've seen, the 10-year bond yield has really not kept up with the short-term end of the curve. And in fact, we've now inverted by as much as 80 basis points in the 10-year 3-month spread, and almost 80 basis points in the 10-year 2-year spread. And that yield curve inversion at the 10-2s is the worst we've seen since 1981. And we all know what followed 1981. It was a very, very severe recession. I think the most important point in looking at the extreme yield curve inversion that we have today is that, as Harley Bassman, my old friend at Merrill Lynch, once said, he's the guy who invented the MOVE index, which is the bond market version of the VIX. He said it's a stone cold fact that the yield curve is the best predictor of a recession. And the fact of the matter is, it's gone 6 for 6 in the last 5 decades. And I'm pretty confident that we're in, the midst of a 7th in the works right now. So I think we're likely to get a recession next year. And the severity of that recession is really the only thing that's up for debate at this point.
Yeah. Jeff, I have a question. How are your business conditions there in St. Paul and in Minneapolis? Are the businesses still thriving, Target and Walmart and stuff? Are you seeing any signs of any slowing down?
Well, Target's had a lot of problems, and it's really been a function of their inability to control inventories. And so, they ordered a lot of the wrong product and have been forced to, really run discounted, promotional sort of environment, which has been tough on their margins and earnings. But, all in all, it's really tough to kind of, discern a major collapse in the economy right now. I mean, that's, it happens gradually and then suddenly. What I think we're starting to see is employment at the margin is being impaired. And these are high-end jobs, like tech jobs. We've seen about 138,000 high-paying tech jobs eliminated in Silicon Valley in the last 11 months. And there's word on the street is that Google's going to cut 10,000 jobs before year end.
Well, that'll probably still leave them with 3 million people, though, but who knows? Hey, Jeff, this is a joke. Hey, Jeff, tell us about this earnings per share decline that you're looking at.
Well, the point is that if we look back in history, going back to 1920, which is as far back as the data goes, we can see that historically earnings have declined by, on average about 29.5% during, every past recession going back to 1920. And, one of the reasons I think that a lot of these big tech companies are cutting headcount by tens of thousands. It's not just Google. It's not just Meta, but Amazon, Uber. I mean, the list goes on and on. They're cutting tens of thousands of employees because, their margins are coming under pressure, and they're trying to stave off an earnings recession, and that's the reaction that you see from corporate America. So we're in the very first inning of that, and, we can even take a look back to, the 2008 crisis where we saw 91% earnings drawdown. The most recent, iteration of that was what happened during COVID, and that was, a very short recession, but earnings collapsed by 32% in that period of time. And so, I think that there's a pretty good shot that we're going to see earnings fall well short of current estimates on Wall Street, and that's going to really support what I think will be a continuing bear market.
Wow. Well, I see the same thing, Jeff, but boy, you listen to the news sometimes and it's saying just the exact opposite, that there's more jobs available and everything's looking good, and it certainly doesn't appear that way. Now we're going to get into the realm that everybody likes to talk about, and that is the good old Elliott wave analysis. And I'm going to get this up here right here so you'll be able to talk to us about this. So we've got two charts. Tell us what you're looking at, Jeff.
Yeah, to your point, I mean, there's plenty of jobs available if you want to work for $15 an hour. But, if you're looking for a high-paying job, you're probably going to have a very difficult time. Our preferred Elliott wave count really can, looks at the market going back to 2009 on the left-hand side of the chart. It's our cycle degree view. It's a 13-year advance off the 2009 low. And we believe that was the end of cycle wave 5 of probably super cycle wave 3, and that we're in the early stages of, at the very least, a cycle degree correction and possibly even a super cycle degree correction. So if we look to the right-hand side of this, that's our primary degree view, and that really looks at the market since, the March 2020 lows. And so we see that final move up, which was primary wave 5 of cycle wave 5. And since that time, we've counted 5 waves down into the June low, and that, in our view, is probably primary wave 1 down of a 5-wave motive wave decline, which will ultimately end up being cycle wave A of an ABC supercycle degree correction. Everything we've seen since June looks to us to be part of primary wave, or since August rather, is part of primary wave 3 down. So, that June low was primary wave 1, the August high was primary wave 2, the October low was intermediate wave 1, and we think the December 1st high counts best as intermediate wave 2. And once we break 3,900 with authority, I think that will confirm that intermediate wave 3 of primary wave 3 down is underway. And we think that that could carry the market all the way as low as, say, 2,750 to maybe 2,400 before it terminates, Larry.
Wow. Jeff, stay with us. Great stuff. We're going to pay a few bills and we'll be right back with Jeff Hughes of Alpha Insights.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Okay, we're back, folks. We're talking with Jeff Huge of Alpha Insights. Just stay with me here 1 second because I need to shift gears a little bit and get to short-term wave options. This is what I don't understand this at all, so go slow for the old cowboy, would you?
Absolutely. So, okay. We're really just looking at the period of time since the August 16th high, Larry, and we're looking at it on an intraday basis. This is a 120-minute range chart. And the count on the left is our preferred count. That suggests that, again, the August 16th high was primary wave 2 of a 5-wave motive wave decline, and that the October 13th low was intermediate wave 1 of primary wave 3, and that the December 1st high was intermediate wave 2 of primary wave 3 down. And so what we're waiting for is the market to confirm this by breaking authoritatively below 3,900. Once that occurs, we can, with high probability and confidence, suggest that the preferred count's correct. But until that happens, we have to hold out, the possibility that we're wrong, right? Hate to admit it, but there are, this is a probabilistic framework that we're working in here, not a certainty. And so if, in fact, the market does push above that December 1st high, then I think we have to acknowledge the fact that this could be a more lateral type consolidation, something in Elliott wave parlance known as a flat. And the flat would be, instead of being wave 2 at August 16th, that'd be wave A up, and the October low would be wave B down, and then we terminate somewhere slightly above that August 16th high in wave C. That would probably end primary wave 2. And then we would then begin primary wave 3 down. So it would simply just delay things by a little bit.
Okay, and this next one is really interesting to me because I've been talking about this for the last 3 or 4 days about what we should get ready to expect when we start 2023, and that is the volatility. I think we're getting ready to start to see a big increase in volatility in almost everything.
I concur, and our work suggests that this is going to be bigger than most. If we take a look at the bottom frame here, that's the short-term momentum study, and we can see a clear positive divergence as the VIX made its most recent low on, I believe, Monday. The momentum actually made a higher low, and so that positive divergence typically precedes a volatility spike. This was the most oversold that we've been in the last 3 years. And in fact, each time we've gotten oversold, the reversal of that oversold has resulted in a fairly sustained volatility move to the upside, usually into the high to, mid 30%. But I think at this point, we could be preparing for a move to challenge that 40% level. And, wow. I think possibly even exceed it. And that's what really gives us confidence in the preferred Elliott wave count that I outlined a minute ago.
Okay, we have a question from one of our listeners, and the question is, do you factor in the foreign markets like China and parts of Europe like the UK and, France, Germany? Is any of that involved in what you're doing?
Well, we look at global markets, but we look at them all independently. It's been my experience that markets, there is an intra-market relationship, but oftentimes it's really the basis of the dollar. And so we saw a lot of strength out of foreign markets this last month because the dollar pulled back, 5% or so. And I think that the dollar is probably bottoming and likely to reverse higher and make a new high over the course of the next year. And so, I think that's just temporary. What we're seeing in, say, Europe, for example, we saw, big months out of the UK and Germany and the Netherlands and, some of these really beaten down markets. And my suspicion is that, we're probably going to see a very, very deep recession in Europe next year, if not even a depression.
Wow, no one talks about the D word over here. That's not in our vocabulary, that's for sure. Anyway, the next one we're looking at is, of course, the biotech, the NASDAQ. And we've got a caller calling in here today. It's probably someone from the Federal Reserve wanting to have your job resume. Hold on just a second. And he's got Steve from Austin, Texas, and he wants to talk about the Treasury bonds. Go ahead, Steve. What's your question?
Well, Larry, thank you for taking my call, and Jeff, good to hear from you guys. I was just thinking we have had such a tremendous drop in the TBT, and what your thoughts were of that. If rates are going to be going up, why is that dropping so much? Because that's the inverse.
Yeah, exactly. So, the inverse trades kind of, exactly like yields, basically. And so it's following yields lower. It's the opposite of prices. And I think yields have probably come into a level that is close to bottoming. We might get down to the 200-day moving average, which will, kind of come in around, say, 320 to 318 or so in a couple of days here. But I don't know. That's a push lower. We're at kind of structural support here in this kind of 340 to 350 level. And I think if we can close the week above 350, it would probably suggest that yields are going to reverse higher. My expectation is to see yields press above 4.5% into the first quarter and possibly even head toward 5% or higher.
Well, that's what it looks like to me because it's come down so much. I mean, it's dropped. It's and it seems like it's down to a level that it's kind of like they've given up on interest rates going up. Everybody's jumping into the markets and stuff like that and gotten away from the bonds, sold the bonds off. But if we have a reversal, I would think that the rates would start going back up. Is that an incorrect assumption or thought?
Well, I think the reason rates have come down is because a lot of money has moved into bonds when they got up over 4%. And there's a lot of fear of a recession next year, and it's showing up in this trade shifting toward bonds. There was also a large short position in the futures on the long bonds, and that's being covered. So, I think at this point that's really what's driving bond yields lower. And, I would suspect we're going to see the reverse of that in the not-too-distant future.
I agree with that 100%,
Thank
Jeff,
you so much.
We've had 2 8-week rallies in a row, Steve, and that's enough for me, so I'd be looking to sell the bonds today.
Yep, that's what I was thinking. Okay, thank you.
That's a great trade, I think, Larry.
Well, it's relatively low risk because if it closes near the high of the day today or opens higher tomorrow, then I would certainly be wrong. Jeff, the next one I want to cover here is how the folks can reach you. It'll only take a second.
Thank you so much.
And
2 8-week rallies in a row, Steve, and that's enough for me, so I'd be looking to sell the bonds
sounds
today.
like I'm on a recording now. Hold on just a second here, and we'll get this up here.
That's a great trade, I think, Larry. Well, it's relatively low risk because if it closes near the high,
I guess I hit a recording, Buck.
Then I would certainly be wrong.
My fault.
The next one I want to cover here is how the folks can reach
I don't know where this echo is coming from. I don't know where it is, but anyway, can you get through to us, Jeff, and tell us how to reach your? Hey, take a break. We'll try to get this corrected, okay? Sorry, buddy.
Yeah.
We'll be right back. 877-927-6648.
If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
TFNN has launched the Tiger Zen, hosted at Discord. TFNN has been educating traders for more than 20 years, with live programming hosted by a variety of professional traders during market hours. The Tiger Zen, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Okay, we're back, folks, speaking with Jeff Huge of Alpha Insights. And Jeff, we do want to tell the folks how they can reach you through your free monthly newsletter that is an absolute value. I'm joking,
absolutely.
Jeff, because free is a good price.
Free is the best price, and we encourage everyone to subscribe to this for free and just kind of, get our big picture view. It's called Huge Insights, the Big Picture. We publish the first Saturday of every month. In fact, we just published on Saturday, December 3rd, so it's hot off the press. And this really kind of highlights our 2023 outlook and, goes into much more detail about the economy and the markets relative to what we talked about here today. And also gives you a few ideas how to position your portfolio for the next, 3 to 12 months, really. So, you can get that on my website. It's www.jwhinvestment.com. You can also find me on Twitter at @alpha_insights. Either way is how you can access the newsletter. And, it's real easy to subscribe, pretty self-explanatory, but we'd encourage you all to take advantage of that.
One question for one of the listeners, final question is, do you ever differ from the traditional Elliott wave counts that we get from the Elliott wave people, or these are your own? Is that correct? That's what the listener is asking.
These are my own. I don't know who the Elliott wave people are. A lot of people think I'm the Elliott wave people, but the counts are subjective and they're based on the time horizon that you're using. There is another organization out there called Elliott Wave International, and they believe that something called the Grand Supercycle is underway, and they're using data that they've knitted together going back to the 1700s. I don't know how reliable that data is. I don't have access to it. The only data I have is market data, publicly available market data for the S&P, which goes back to 1925. So that's the data I'm using. But it's really just semantics, Larry. It's are we in a grand super cycle or a super cycle or a cycle? 5 waves are 5 waves, and as long as we're working from a top at the end of wave 5, then we should be at the same understanding of what's happening in the market.
My cycle ends on the close today, buddy. So we'll have you on again soon, and happy holidays to you, okay?